Good morning, everyone. We will be starting today's session shortly. Welcome to today's panel discussion on the impact COVID-19 has had on Sri Lanka's banking and finance sector. Today's event is hosted by the Advocata Institute and is the fourth installment of our series on COVID-19. We are an independent policy think tank working to promote sound public policy ideas for a freer and more prosperous Sri Lanka. This event will be live streamed on the Advocata Facebook page, as well as on the Facebook pages of our partner institutes, Business News LK, The Sunday Morning, Citizen, Economy and Business, CFS Society Sri Lanka, Advocata Biz, and the Night Watchman Society. Today's panel discussion will be moderated by Mr. Murtaza Jafferjee, the CEO of JB Securities and chairperson of the Advocata Institute. Our panelists today are Ms. Yvette Fernando, Assistant Governor of the Central Bank of Sri Lanka, Mr. Manil Jayesinghe, President, Institute of Chartered Accountants of Sri Lanka, Mr. Roshan Abeygoonewardena, Chairman, the Finance Houses Association, and Mr. Jonathan Alas, Managing Director and CEO of Hatton National Bank. A few quick housekeeping points before we move on to today's session. We would appreciate if you keep your microphones and cameras switched off the duration of today's session. If you are having connectivity issues, we recommend that you switch to the Facebook Live, as the connection might be more stable there. We will be having a Q&A session at the end of today's panel discussion. Please send your questions in to Slido. To do so, simply Google Slido. They will ask you for an event code. The event code for today is COVID-LK, and press on the green button that says join existing event. We will be, the Slido questions will be used, brought up by Mr. Murtaza Jafferjee. You have the option to upvote interesting questions as well. Hope everything goes off well. I'd now like to hand the virtual mic over to Mr. Murtaza Jafferjee.
Thank you, Anita. Good morning, everyone. My name is Murtaza Jafferjee, and what I will do is in today's panel that I will try to give you a sense of how the banking and finance industry works. It's much easier to understand a business like widgets, where you either produce or export a particular product. Banking and finance is a little bit complicated, and it took me also many years to figure it out. So what I'm hoping to do is in the next 23 minutes to give you a very quick overview. There are many slides here. You may not be able to keep up with all of them, but we will put it on the Advocata site subsequently. So this is kind of setting the foundation for the discussion that will follow. So initially, what does a financial system do? I mean, it has four fundamental functions. One is it facilitates payments. It facilitates insurance service, where you can transfer risk and pool it with others. It creates a market in financial instruments like foreign exchange, commodities. And most importantly, it facilitates financial intermediation, where it bridges between surplus units, who are the lenders in an economy, or the depositors, and deficit units, who are the borrowers. And it also does what is called maturity transformation, and generally the depositors are more short-term and the borrowers are a bit long-term. So what role does credit play in the economic engine? So what drives the economy is spending, and it's a function of money that you have plus credit. And when credit expands, it magnifies spending. And when credit contracts, it reduces the amount of spending. So basically, the central bank, whose mandate is to have stable economic growth, will try to ensure that credit is growing all the time. This shows you the relationship between the credit aggregate and nominal GDP. The top shows you private sector credit over a long period of time, almost 20 years. And except that year 2019, which was the year that the conflict came to an end, we have always had positive private sector credit growth. And you can see towards the end of 2019 that it has been coming down, almost closing on zero. And the graph at the bottom shows you nominal GDP, which is including the inflation angle. And it shows you the expansion of total credit. This aggregate is on the banking system. And you can see that there's a clear relationship. The right-hand chart shows you basically credit in the economy. And you can see that leading up to this, the latest credit figure on a year-on-year basis, it had come down to something slightly below 5% private sector credit. So who are the players in the financial system? And this is the total size of the financial system. That's about almost 20 trillion. And our economy is about 15 trillion as of end of 2019. 71% is the banking sector, which includes the central bank, which is about 9%. And then you have other players like the contractual savings institutions, which are the EPF and ETF. And then you have insurance companies also in that. And then you have other deposit-taking institutions like finance companies, and then a whole bunch of very small entities. So the field is divided into the regulated has three types of licensing. One is the licensed commercial banks, licensed specialized banks, and licensed finance companies. In the licensed commercial banks, we have done a collage of all the different players. And the one that is in purple are the two state players, Bank of Ceylon and People's Bank. And then you have the private sector banks, which number about 11, which is the middle. And on the right are the foreign banks, which are basically branches of big international banks. Moving on the left is what you see as specialized commercial banks, which are licensed specialized banks. And that shows you a splattering of who they are. Of course, the biggest one is the National Savings Bank, which is the only entity that has an explicit sovereign guarantee on depositors. And on the right are the licensed finance companies. And we have just included the major 8 players or 10 players. And there are about 37 other smaller players. So the total number of finance company players are 43. So this is a stylized, this is a balance sheet of the two sectors. One are the commercial banks and finance companies. And on the left, what you see is the commercial banks, and it shows you the asset breakup of the commercial banks and the liabilities. So you can see that the loans to advances are about 63% of the assets of the commercial bank, and the deposits are about 75%. And the ratio of loans to deposits gives you the loans to credit ratio, credit to deposit ratio. And it's been fairly healthy so that our banking system is not excessively reliant on wholesale borrowings. On the right is basically the finance companies. Obviously, the size of the industry is significantly smaller. And you can see that as a proportion of assets, they have a lot more interest-bearing assets, interest-earning assets. And on the right side, you see how they fund it. And unlike the banks, they have to rely on borrowing. They have a greater share of borrowing. So very quickly, what drives credit extension? So obviously on the left is the issue of affordability, and affordability is not only a function of interest rates, nominal interest rates that people pay, but it's also depend on how long the facility is for, what is the income of the person who's borrowing, and some kind of debt service ratios. It also depends on the credit worthiness of the borrower. So it depends on the collateral they have, and how easy is it a movable asset or not, how you can assess the income, because it's not everybody who's in the formal employment sector, and any kind of credit enhancement is somebody guaranteeing them. Then it also depends on the amount of credit, also depends on the regulation, because it's generally extended from institutions, and there are certain restrictions of how institutions can operate. It also depends on government policy. So there are directed lending norms that certain sectors should be getting a certain amount of credit, and there are some underwriting sometimes offered by the government. And it also depends on the infrastructure that you have, the kind of information systems and things like the crib that kind of gives you a history of credit of a particular borrower. So generally, Sri Lanka's private sector credit to GDP is very low. It's about 52%. I mean, if you look at some of the regional peers, it's lower. But if you look at some of our Southeast Asian tiger economies or the second tier tiger economies, it's significantly higher. And one reason for that is that typically the financial deepening in those economies are much higher, because households probably own many more financial products, Most of our households who have a formal banking relationship probably has a cross-sell ratio of about 1.5. And the regional households probably have 3. So there is more financial intermediation within the households. In Sri Lanka, it's more like people will earn an income and use that income to invest. They won't channel it through the financial system. So in the banking sector, who has these advances? So the total advances are roughly about 7.8 trillion. 7.8 trillion. So that's about 51% of GDP. And this shows you the x-axis here is the share of that credit. And the y-axis is over the last 5 years, how each entity's loan has grown. And this shows you the average rate that it has been growing at. So you have smaller banks who have been more aggressive in growing their credit. And the larger existing players like the state banks, the People Bank, Bank of Ceylon, obviously they're growing closer to industry because of the sheer size. And at the bottom, it shows you what their market shares are. And you can see that the more aggressive players have been gaining market share. And from the market share on the top right shows you the distribution of market share of loans and advances. State banks, the two state have about 42% and the private sector has about 58%. This shows you basically where the credit went. And this is our estimate from M4, which is including the commercial licensed finance companies. And the donut chart on the left shows you which type of institution has originated the credit. So the commercial banks have given 74%, the finance companies about 15%, and the licensed specialized banks about 10%. And this is to the private sector. And this area chart shows you where the credit went. Now, at the bottom, you can see that a big role has been played by the construction sector. So there is some kind of classification system that banks are guided by in reporting. But having been a bank director myself and been an analyst, sometimes, you're not sure where this gets bucketed. But all those buildings that you see coming up in the city of Colombo and many other places, a lot of that has gone through the construction sector and some of it through real estate developers. The red line that you see somewhere in the middle, the dark red, that is the exposure to tourism. And in a session last week, I showed that the tourism exposure is about 3%. It's about 240 billion is the credit to tourism. And pre-COVID, about 100 billion of that was under moratorium. And then going up, you can see that just below leasing, there's other personal loans. Now, this is generally unsecured and it's about 12% of this total. And then you have leasings and other loans for finance companies. Sorry, I'll just go back. One other thing, that pawning, that you can see this pawning, there was once upon a time before the gold price crashed around about 2012 or 2013, the pawning had gone to something like 14%. But as you can see here, it's now a much smaller figure. So what is the structure of our economy? And the Department of Census and Statistics in 2013 did a survey. There is no more recent one. And they came up with about 1 million establishments. And a majority, something like 92% of these establishments are very small, four employees or less. And the larger, fewer number of enterprises, but obviously the larger companies represent about 25% of the employment that they surveyed. But the micro enterprises, the very small one, accounted for something like 44% of total employment in that survey. So our economy has a lot of these small entities. The next slide is a labor force survey. And it's estimated on that in 2018 about 8 million people. So there is some element of seasonality, and that figure is between 8 million and 8.5 million, depending on how you categorize employment. And you can see that the informal sector is 58%. And the graph on the right shows you basically where these people are. And so in the formal sector, let me just show you some figures. The EPF has about 2.5 million members. So you could assume that those people are in a formal sector, because to be eligible for EPF, you have to work in an enterprise with at least 15 people or that's the mandatory requirement. And the government, basically, the public service employs about 1.2 million people, and the SOE is about 200,000 people. So there's about close to 4 million people, or slightly less than that, that are in this formal sector where they get salaries, etc. This shows you, in terms of the finance companies, how they have lent and this is a product-wise analysis, not a sectorial analysis. A significant amount has gone as leases, and then a significant amount secured loans. So they could be even things like hire purchases and mortgages. This shows you the category of leasing. This is only leasing. And the left-hand side basically shows you the leasing portfolios of different banks. And on the right side is the leasing portfolios of different finance companies. And you can see that the finance companies are significantly larger than the banks because that is their core business. This shows you the collateral that the banking system has against these loans. And you can see right at the top that the unsecured, the dark gray part has been increasing. So this is probably clean lending. And then at the bottom, the big chunk is immovable property, plant and machinery. So that is traditional lending. And that share also has remained about the same. This shows you the performance of some collateral items. Land, basically, this is for the Central Bank Index in the District of Colombo, over the last 5 years, basically has been on fire. So it has almost gone up 85%. Right now, the question I'm putting this is some of that collateral value, the sizes of the loans have been dependent partly on the collateral value. And the question is that in this kind of economic crisis, whether this graph that has been going up is suddenly starting to go down. Now, this has never been experienced in Sri Lanka, where land prices a few times during the 2009 or 2008 the Selinco crisis and a few other crises before, land prices did come down. But the question remains that after such a huge bull market, whether we are going to see a contraction in land prices. Then gold has been on fire, basically, the dollar price. And we have computed the rupee price by just conversion, but there are some taxes. So the actual price of an ounce may be higher than what we are showing here. And on the right side is basically another collateral item on which these visas are, which is basically the vehicle fleet. And we have about 3 million two-wheelers, about 1 million three-wheelers or slightly less than that, and about 1.4 million other vehicles, of which cars are about 400,000 to 500,000. Now, car prices always kept going up in Sri Lanka because the duties went up, the currency depreciated, and many households look at it as a real asset. But for the first time, are we going to see, although they are banned importation of cars, because of this crisis and forced sales, are we going to see reduction in vehicle prices? Moving on, one other asset on a bank's balance sheet, and this is not for finance companies, is the reserves that they have to keep with the central bank. And that is called the SRR, the Statutory Reserve Requirement. And the regulator has been reducing that to improve liquidity. So a significant amount of reduction has happened, which means that the banks can use that to meet liabilities that have been withdrawn or to extend more credit. They also, the regulator imposes certain liquidity requirements, because basically, you have liabilities, which is depositors and borrowings, and typically you want to ensure that they have a sizable amount of liquid assets to meet those liabilities in case there is a withdrawal. So typically, according to the Banking Act, from recollection, about 20% of interest-bearing liabilities have to be held in liquid assets. The NSB is an outlier there because statute forces them to have 60% invested in government securities. And the licensed finance companies, the liquidity requirement is a lot less, which is about 10%. There has been some relaxation. I will come to that. So how have these investments in liquid assets, how have they been accounted for? So if you take the banking sector, significant amount is held to maturity, which means according to the banking rule that you accrue the interest, contractual cash flows is accrued till the maturity period. And you cannot trade it, you cannot sell it. And then a substantial amount is held for trading, which means that you can sell it. but the mark-to-market gains, the continuous fluctuation prices, that doesn't come through the income statement. It goes through something called other comprehensive income. And on the right shows you the composition of investments of licensed finance companies. Again, a lot of it is government securities. They have a small amount in equities, etc. Now, why did I bring this up? Because of this. Some of these liquid securities, all liquid securities don't need to be held in rupee securities. And some of it can be held in dollars, provided you have dollars. And some of the banks, big banks who have reserves or what they have earned over the years in dollars from their offshore book or even domestic book, which they have earned in dollars, they have kept their profits in dollars also. But of course, on the asset side, they can use it for liquidity purposes. And they have invested in the Sri Lanka sovereign bonds. Now, after this COVID crisis, our bonds basically took a hammering. And I have detailed on the left the sovereign bond that is coming up in October 2020. That is the price chart. So these have a face value of 100 and the prices at which it's trading. So you can see that there was a significant slump leading up to the end of March when there was almost a crash in the markets, but the markets have recovered. And you can see that our bonds also have slowly recovered, but they're not back to their face value. And the 2030, which is more further out, has not recovered. So the investors are probably betting that, you know, the 2020, we will not default on that, but a longer term, there's more uncertainty. Now, the question is that how we are going to account for this in 31st March. And these prices that you see basically are bid offers. They're not actual trades. That's how the Bloomberg gets this thing. What I have put in the middle basically are two tables showing actual trades. So the sovereign bond 2020 in bold are the trades that have happened closer to 31st March. And 2013 below the table is given in the middle. That shows you in bold the trades that happen again closer to 31st March. Let's move on to the liability side of the balance sheet. So the deposits with the commercial banks, who owns them? And about 71% of those deposits are owned by individuals. Now, the way you categorize individuals is if you run a proprietor business or even a partnership, the balances of the firm are counted under the partners of proprietors. So that part also may be coming inside here. And then you have other firms and other businesses who have part of the deposit. So mainly it's the households basically who have been funding the deposits of the banks. In the middle, basically, you see the product-wise breakdown in what type of product, and a lot of it is time-based deposits. There are current accounts right at the bottom, demand, and there is an element of savings deposits. As I said, the individuals own the deposits, and on the right-hand side shows you the age structure of the population. And we have about 12% of the population that is above the age of 60. Generally, those people, because they are more retired, they are more dependent on interest income that they earn on these deposits. And because they have worked all their life, their accumulation of financial assets also are greater. So although they comprise only 12.5% of the population, they probably own about 25% of these deposits. And who controls the deposits? This chart shows you, again, it's the state banks that have something like almost 49% of the deposits because of the National Savings Bank, and which has an explicit guarantee, and on the other two banks, maybe there is a perception of an implicit guarantee that there will be state support. And the private sector has about 50% of the deposits. And the deposits over the last 5 years has been growing at about 14.3%. So what has happened, as I said, that some of these deposits have got converted to currency. Because we are in this lockdown mode, historically, leading up to Aurudu, because of traditions like Ganudenu and a lot of transactions, people do withdraw a lot of cash. But this time, this is again sometime in April, I have the figures, there has been a significant spike in the cash in circulation, cash with the public. Now the question remains that after the end of this curfew period, whether that cash will come back to the banking system. But during this period, because people have come and withdrawn their deposits, the banks also have a slight liquidity pressure because they have to pay out deposits because people want to hold more currency. One other form of funding of the banks is through borrowings, and wholesale borrowings is not that large, but when you look at the composition of the borrowings, the local borrowings probably will be of the nature of things like repos, where you have put an overnight repo on an existing government security. But the foreign currency borrowings are things that our banks have borrowed from regional banks and swapped it into rupees. So we will ask the panelists what the market looks for that. Okay, let's look at the capital, and then the regulator has set certain capital requirements basically between at different, because these are the buffers, and these capital has to be adjusted for a capital adequacy ratio based on the risk assets. So what does that mean? So there's two types of capital. So there's tier 2 capital, which basically is about 230 billion. And the nature of this tier 2 capital is that it is contingent converter. So if a trigger event happens and the equity cushion of these banks erodes significantly, that will convert to equity. And on the right, I have tried to show off all the issuers, all the local banks who are issuers of these debentures. So this shows you the capital adequacy ratio. So you have the state-owned banks, basically, whose risk-weighted assets are significantly lower relative to the total assets, because lending to the government is zero risk-weighted. In the case of People's Bank, it's even lower because they carry a large bonding portfolio. And if you look at the private sector banks, because they lend to the private sector where the risk weighting is much higher, this ratio is much higher. So the state banks actually enjoy much higher leverage to the private sector banks. This shows you what the situation is for finance companies, that the risk weighting of assets is even above 100% because some of their lending is weighted at about 125%, and they operate at lower leverage. Some people like Central Finance, extremely low leverage. And this shows you the dividend payout ratios of the banks. So this is including stock dividend and cash dividend, and this shows you, so the stock dividend really doesn't go out, it's just like a bonus share. And the finance companies have also had some kind of dividend payouts. And this shows you the capital raised in 2019 by different banks. And it shows you, what this is showing you is the y-axis is the total value that they are raising. But the purple is basically when the rights issue is closing, how much of that intended capital that they wanted to raise they're getting. And you can see that in 2019, the 4 examples that I've shown, that when the rights issue closed, they were unable to get all the capital. And 2 banks basically had to close their capital raising without raising the total amount. So this shows you the revenue of the banking sector, and there is the net interest income. And what has happened is the net interest income has been growing, but it has not grown because the margin has been going up. It has mainly been growing because the assets have been growing. And this shows you what type of intervention the regulator has been having. And it shows you the purple shows you the interbank rate, which is what the regulator is trying to do by reducing the policy corridor. And you can see there's a huge spike in liquidity because of the middle. And because we are in a crisis situation, the central bank is forced to monetize the deficit, and their holdings of government securities has been going up. But the whole interest rate structure in the economy shown by the right side has been coming down. This shows you what is happening to the interest rates these financial institutions are facing. So the left side is the deposit rate. And what is the key one is in the middle, the new deposit rates have been coming down. And on the top, I have shown the deposit, the finance companies have a deposit. Finance companies have a deposit ceiling, and that recently has forced the deposit rates down. Now, the banks don't have a deposit ceiling. And one discussion is going to be what's going to happen is that whether the banks are going to crowd out the finance company deposits because they can't price up. The middle chart shows you the lending rates, and you can see all the rates are coming down. And the lending rate, which is the weighted average, is coming down at a slower rate, but the new lending rate is coming down. And on the right side shows you the spread between the two. So the currency has been under pressure, and the currency has, as of yesterday, it's about 193. And one of the reasons why the currency has been coming down is that the holding of government securities by foreigners have been going down. So it is down to about 40 billion, and it's a very small amount of the total holding, only 0.4%. So these are some areas that banks earn income from, non-interest income. They facilitate payments, they do forex transactions, they do guarantees and distribution. And this kind of gives you an environment of what's happening there. So the remittances basically up to March are only down 1%. The tourism earnings obviously have come down in the second graph. And there have been recent import restrictions. And we did the computation that based on 2017 trade figures, because I don't have the detailed ones, it's about 15% of imports is where these trade restrictions are coming. And on the right shows you another avenue of banks making money, which is based on card payments. So what are the main expenses of the banks? So 43% are personal expenses. And this shows you on the left-hand side the personal expenses of the different financial institutions. And the middle shows you the employment. So my analysis is that, the whole financial sector, the employment will come close to 100,000 people across all the different formats. And cost per employee figures on the right. The banks, working at a bank is fairly a lucrative employment. This shows you the distribution of the branch network. So the map on the left shows you the branch intensity as a number of people that are supported by a branch. And you can see the state banks have large number of branches in the middle. And what I've done is on the right to show facility costs. So this is the rental cost, and even if you own a property, what the depreciation cost of that physical footprint is. This shows you another area where banks do spend, have to spend. IT expenditure is very high basically, because this is a highly digitized industry. And the IT cost is the expense that comes into the income statement, which is the middle, and the right shows you some other expenses, which are also high, like professional fees, and there are many other elements. So what happens to the cost structure of the banks? And the left graph here shows you that the income has been growing much faster than the cost base. And the middle shows you the cost to income ratio basically. And you can see that for all entities, the cost to income ratio has been coming down except for 2019 where it has slightly reversed. And the right chart shows you the operating income. So basically it's showing that the operating income is going up, but as a percentage of assets, it's been coming down. Then very quickly, we have the issue about provisioning. And there are three types of provisioning that hopefully Manil will be able to speak about. One is the incurred loss model, which means that you start providing only when the loss has hit you. The expected loss model, which is basically you, in anticipation of what's going to happen, you start adjusting. And the right side is the historic time-based central bank provisioning, which slightly differs between finance companies and banks, but it's after 180 days that you have to start providing. Then we go to, I will skip that. And this shows you the trend of the credit cost of most of the major players. And that has also been going up. So the taxman has given a reprieve that the taxes have been reduced and the effective tax rate will come down. And the profitability of banks have been coming down. So although the absolute profit is a large number, over 100 billion, the profitability has been coming down. But unfortunately, investors have not benefited because the stock prices have come down and the price to book values of most of these banks have come down to about 40%. So lastly, what are the moratoriums and regulatory relaxations offered? So basically, the loan moratoriums have been allowed for between 6 months to 2 months for different categories. The relaxations have been on capital, that minimum capital has been deferred by 2 years and the systematic buffers have been allowed to be used. The liquidity requirements of finance companies have been reduced. There have been some working capital facilities for something like 50 billion, where it will be at an interest of only 4% and the central bank will compensate. And there are some things on financial reporting. One is the accounting for so-called modification of loans and mark-to-market accounting. And this shows you finally basically an illustration of this modification accounting. So that brings an end to my presentation. I think I took a few more minutes than I anticipated. And I would call upon Jonathan basically to provide us an overview of what's happening in his industry as it is, what are the challenges he's facing, and perhaps a forward-looking thing of what he thinks will happen going forward, and some of the, most importantly, some of the opportunities that are there for him. You need to unmute, Jonathan.
Hi, good morning, everyone. I hope I'm audible. People can hear me. Firstly, thank you to Murtaza and Advocata for inviting me on this panel. A very interesting presentation, Murtaza. Gave us a lot of information with regard to the banking industry. In terms of where are we now, how do we get here? Obviously, extremely challenging times that, you know, most of us have not seen before. You know, I remind myself of 2008. I was not in the country at that stage, but you know, back in the Middle East, we had the same challenges at that stage with, you know, Dubai going down with the financial crisis, as well as Abu Dhabi, all its investments overseas in the West, in Europe and in America, taking a massive beating and had to work round the clock to try and get a grip of situations. Back here in Sri Lanka, what is different this time is then it was a pure financial crisis. Today we have got even a medical crisis, a health crisis, and then that could lead to a very, very serious economic crisis. The good thing is the government realized at a very early stage and took action, inviting both central bank and us commercial bankers around the table and said, we need to get back to work. Let's make banking services an essential service. Let's try and keep as many branches open as possible. Was a bit concerned at that stage, but we have seen how it has actually helped. And today we open many more branches that we did previously. Almost 3/4 or more of our branch networks are open today. A cue there for us to take is that we can now slowly start easing off from low risk to high risk in a cluster form in industries which are less concentrated than the others, than more concentrated, and slowly start kickstarting the economy. The other important reason for trying to meet up as soon as possible and get us started was in order to provide the financial relief that it was required. So it was two-pronged in terms of making it essential service. One is to serve the day-to-day requirements of our consumers, like withdrawing cash, enabling them to complete their purchases, etc. But the second and equally more important thing was, how do we then support some of these businesses which had come to a grinding halt? How do they pay their salaries and other essential expenses for which, with the guidance of the government, central bank, put up many relief programs in terms of some of the extensions, the moratoriums, and the working capital programs that you alluded to a couple of minutes back. So while part of the bank is servicing customers at the counter, there is another group that is working behind the scenes, calling customers, asking for SMSs, asking for WhatsApp, in order to get these credit relief application forms completed at our end. Thousands have been completed already. Now we have got an extension from 30th April to 15th May. That's going to help us even more to get more requests coming in so that we can process them over the next 2-3 weeks, and customers will have their relief programs in place during the month of May and June. While this is in place, what we need to realize is at situations like this where the bank comes through, I think I need to remind everybody that this is not the first time that the bank has come through. We still have some of our, moratoriums out of let's say, floods, droughts, the Easter Sunday debacle in terms of the tourism relief provided, then the SME relief given in November. We have just not even recovered from it. Now we have gone into a COVID-19 relief. So, I mean, I need not remind everybody, at the end, banks work with money at call, lots of CASA balances and fixed deposits, which are essentially 3 months, 6 months, 12 months. So it ideally is structured to cater to working capital facilities and short-term facilities. Obviously, we are finding how short we are on the equity side, as well as the being short in terms of a development banking type institution in Sri Lanka, in order to bring long-term finance, in order to structure long-term loans, project finance, syndications, etc., which private commercial banks are taking a bit of a chance, looking at their some of their core balances and leveraging them to do even medium to long-term loans. This, in addition, would be useful, and I believe the government is engaged in this at the moment, which is talking to the likes of World Bank, IMF, ADB, and looking for long-term relief at very concessionary rates. Now, these have got to come into the SME in order to fund them, because banks continuing to give relief, first, it risks the financial sector. Secondly, it's not going to help SMEs further leveraging them to get them out of trouble. So some kind of help needs to be done. So multiple structures need to be thought through. When we get into the crisis, what happens is we look at very short-term solutions. But if we think about it, that we need to be ready for crises like this on an ongoing basis. So within industry, using your tax instruments, etc., you need to create funds to sustain these industries in the long term. This is the time those funds would have come useful in order to support some of these industry players, so that they are not over leveraging to come out of trouble. Otherwise, for the rest of their lives, they would be actually servicing bank debt and never coming out. Something equally important in good times, the same way we are helping these industries in difficult times, in challenging times. Yes, I agree, we need to do it. There has to be an equally effective structure in good times. How do you improve accounting, savings? How do you improve equity building? How do you bring more discipline rather than the diversion of funds that take place the moment you make the next rupee in terms of profit? These things need to be carefully structured in developing SMEs and the other industries. Otherwise, there is this thinking that helping SME means to give money. There's a lot more that needs to be done in terms of financial literacy, and I think it's time that the authorities looked at it more holistically. Whereas for the top corporates, I see an opportunity at this stage for them to look at equity investors, those who believe in the Sri Lankan story, who believe in our tourism story, in our exports, in our garments and etc., and who would be willing to put some equity at this particular moment, taking a long-term view of 2 years, maybe no dividends, 3 years possibly dividends, and then maybe listing some of these companies in order to make our stock exchange more attractive, as well as create more liquidity and create more equity for some of these companies, as well as sharing the spoils of some of these top-rated companies amongst investors in Sri Lanka. Just moving on in terms of what's happening right now with the balance sheet, whilst we don't see any growth on the asset side, quite understandably, other than the small working capital facilities which are being granted, most of them not disbursed as yet. The expectation was to disburse them in May and June in order to meet May-June commitments. So the balance sheet on the asset side is more or less flat as a combination of some of these working capital loans, then the fact that moratoriums are given and no increases, no repayments are kicking in, and there's a wait and see approach taken by corporates and others in terms of their investments. So some of those drawdowns are not taking place, other than essential import loan settlements and LC retirements, etc., for which we have seen a significant reduction owing to it being now limited to essential services. Surprisingly, on the deposit side, while we expected there to be certain amount of panic and for deposits, people to be withdrawing more than what they require and trying to keep excess amounts in their house, we have actually seen something to the contrary, which maybe later on when Yvette gets on to her time, she will probably try to explain whether the 300 billion pumped in has any impact. My take from this is salaries are coming in for March and April, less opportunities to spend other than on essential items. There has been a tax relief that has been given, so higher disposable income, and you're not servicing your loan, so those monies are just lying in the account, and these amounts are just lying. They are not placed in fixed deposits, etc., which means we should not count on these balances as sustainable long term. The moment the opportunity comes, whether the customers will require them for their planning, their other investments, their expenditures. In this deposit build-up that we see across the industry, we will also observe certain contingency funds of corporates, etc., who are just probably accumulating their funds in order to meet the expenses for the next month or two. So it's a combination of that we see. And like you said, the cash has gone up by almost 50%. In terms of our holding across our ATMs and with our outsourced vendors and in our branch network. So you might call it contingency, but it's a little beyond the contingency requirement, and partly I would think because central bank is open only for 2 days a week to collect cash, and I would probably urge them to open a few more days so that more cash can be deposited with central bank in order to release some of this excess cash that is lying in the banking industry. Moving on in terms of the P&L impact, yes, we will see NII will be impacted in terms of the interest margins. Murtaza will continue to come down because of the low interest rates that prevail and will continue to prevail. And in the absence of loan growth, it's going to impact further as well. And let's not forget, if we are to do any kind of lending, and which a primary source of new disbursements or lending was the repayment of existing loans. And in the absence of that, when you have got to generate deposits in order to do that new lending, your costs are going to increase further. And you're not also so certain of some of these loans where moratoriums are given, although interest is accrued, how much of that is actually recoverable in the year 2021 and there onwards. So there is a view that the banking industry should take there. But the most important point that needs to be taken into account is the accrual might not show a great deviation, but the important thing is to know how much of that is coming in cash form, and probably not so much, because through the moratoriums, accruals are happening, and thereafter, it is likely that we would have to give a certain amount of time for these customers even to service the interest. So the cash element of the profit or the cash element of the NII would be significantly reduced in the year 2020 vis-a-vis previous years. NFI, you showed a couple of slides, will reduce significantly owing to, let's say, very low LC volumes until some of the releases take place. In the absence of new projects, etc., guarantee income is going to reduce substantially. We have already seen in the month of April a significant reduction in card income as well. In addition, you spoke of other fees relating to payments, etc. You know that as part of the relief scheme, whether it's check return charges, stop check charges, all those charges, there is a lot of check returns and stop checks happening at the moment in the economy, but there are no fees being collected. It's just one hell of a operating cost only in managing this particular process. So in terms of other income, even if you take digital fees, etc., we have seen a massive shift. Whilst COVID is a very dark, heavy cloud, which has, just come upon this world, there are many silver linings in that. And one of it has seen the online platforms that have come in. Those who were hesitant to going to digital banking, to going to cards, to going to products like Solo and wallets and using their mobiles for transaction, are today doing it quite comfortably. And we should never go back. At the previous webinar or program I was on, Seelan from McKinsey was there, and he kind of said COVID is that good nice bullet which gives you one in the belly, never to go back to where you were, and it's that steroid that propels you to do all what you were planning to do in the next 18 to 24 months. Let's get it done within the next 6 months. And we try to call it the new norm, and that new norm is about supporting this central bank initiative of Go Digital Transformation 2020. Make sure that all your customers start using the digital channels as opposed to clogging the counters. Save the counters for relationship management, advisory, and other services, and then collaborate with all other industry participants in terms of right now with the essential service providers, the pharmaceuticals and others, in order to get involved with logistics, warehousing, and create that great experience for our consumers in making things available at short notice and conveniently in a place of their choice. I hope these things, along with that, you alluded to operating costs. So things like flexible working from home, heightened changing in policy and procedure manual relating to health and safety, new hygiene factors, following COVID-19 guidelines in order to maintain social distancing and everything else, and getting people back to work. All these are things that we would do whilst looking for all avenues to trim the waistline, cut costs where it makes sense in order to cater to, let's say, anticipating lower profits, lower revenues, to try and achieve a somewhat reasonable profit for our shareholders in the industry by being reasonable with our costing as well, by maybe deferring certain costs, non-essential IT projects, etc., putting digital in the forefront, and some of the others, at the background, which are not critical, not regulatory, etc. I see a requirement now with everybody going digital. You showed all those branches, etc. Whether we need 25% of those branches, or whether we need to actually give assurance that our mobile vans will get there, our digital footprint will reach these customers, feet on street sales personnel will take care of their requirements. And if all of us look at a 10% reduction, that itself would lead to lower number of branches and will promote digitization further. So just to sum up in terms of new norm, new business areas, new cash flows, leading you to revisit your business model, therefore your operating model, digitization being in the height of it, along with looking at process efficiencies, and then looking at new fitment into the new org chart, reskilling and refitting your staff into new areas might be some areas for us to look at, not in 3 months or 6 months time, but right now. Revisit your strat plan, get these changes done, and start executing. Shall I pause there for the moment?
Yes, Jonathan, thank you. Very briefly, if you can answer briefly. During this curfew period, what percentage of your staff are working?
We had at least 50% of our staff working. If we have 5,000, we generally have about 2,500 working. We have more branches open. Why all can't be open is there is a restriction in some of our staff traveling cross district. So we tend to operate maybe at 3/4 strength or whatever in terms of branches. So managed with people working at home. A lot of us spend loads of hours working from home. Like we do our branch visits and stuff during the morning, do our meetings in the afternoon, and then get down to our day-to-day work only in the night. So it's almost a longer day than the normal day that we have had. That's my personal experience for the last 1.5 months. In head office, we have had a structure of half of them being in office and half of them working from home. Even our call centers are working, let's say some of them are operating from home. We have got some of our centers of excellence, centralized operations unit working in combination. So we have not had to bring everybody to office. There is a decent percentage of them working, doing their day-to-day work remotely from home itself. So I would say 50% is probably an average figure over the last 6 weeks, and increasing now given that we are opening more branches, both in curfew areas and non-curfew areas.
Okay, Jonathan, just two other quick questions. Did you say that your till cash basically is in excess of what you statutorily require and that you want to deposit currency back with the central bank?
Correct. So for example, if I had a comfort factor in terms of the amount of cash I need to maintain in my ATMs, and with those who actually replenish the ATMs along with what I need to hold in my treasuries at the branch level, over the last few weeks, we have been collecting a lot of cash. And it's not only, I mean, yes, we missed the Awurudu, otherwise you would have had a lot of cash coming back at this time, which we were used to customarily. But this is something I think a little beyond that as well. I mean, if there's an opportunity to put back some of these monies, I think from a security point of view, from an efficiency point of view, it would be an improvement. That's what I said. I've got about 50%, and that must be true for the industry as well.
Okay. The next question, very briefly, is the 50 billion working capital facility. Basically, you know, there's about 7.5 trillion worth of credit out there, and 50 billion is a very small amount. It's like a pea shooter when a bazooka was needed. Do you have a sense of, you know, what your share will be of that 50 billion?
Given that we are 10% of the market, I would expect us to do about at least 5 billion of that working capital requirement. Given the number of applications we have done, I think we would easily get there as well. Obviously, as per the central bank circular, our priorities are up to 10 million first, and then from 10 million to 25. And if then it's available to look at some of the other areas. One thing that we take into account is we don't work on your historical working capital requirements or your turnovers. We look at what does it take for you to sustain yourself in the months of May and June. Therefore, we compute a relatively lower figure so that actually there is more to go around rather than funding let's say lots of stock and stuff like that, because people seem to have stock. This is more about, you know, paying the bills and paying salaries and maybe a few critical suppliers who are long overdue, and then keeping the business going and hopefully ready to run.
So very quickly, I mean, if you think you like 5 billion, the applications for that 5 billion is how much? Is it 10 times more, 5 times more?
At this particular moment, I would say we still could take a little more. We are getting lots of it, but not for very big amounts. Yes, if you take the large corporates and all that, their working capital requirements are much larger, but some of them we are trying to work, you know, outside the scheme as well. Whereas here the priority, we tend to work with those sales turnovers less than 1 billion in critical sectors where it's really needed, and the weight is more towards those under 10 million requirements, and then the 10 to 25 million next. So at HNB itself, there's a little more room for us to look at and continue to use the extended period given by central bank until 15 May to continue to accumulate a few more application forms, given that not all we have not found it easy to contact all, and they have not all have submitted us the required information, and we know there are some out there who need help and we need to try and reach them fast.
Okay, thank you, Jonathan. We'll come back to you later. Roshan, would you like to give us an update about, as the chairman of the Finance House Association and also running a finance company, what the challenges have been? And also brief us about any distortionary impacts that are coming from the regulation and also what the banks are doing.
Yeah, thank you, Murtaza and Advocate, and then Murtaza, thank you for inviting me for this session representing the NBA 5. To start with, I would like to give a little brief of the industry for the benefit of the viewers. The NBA 5 predominantly cater to the lending
Roshan,
customer.
you may want to speak a bit louder.
Okay. Lending customer, our customer base mainly lending customer based on the micro and micro SME. It could be self-employment and individual. So this is the customer base that we are catering to. So industry presently we have about 7 million customers, of which about 60% about borrowers is from borrowers and about 40% is from depositors. And also our industry house about 32,000 employees, consisting of 42 NBA 5, of which 33 are listed on the Colombo Stock Exchange and 9 unlisted finance companies. Like even if you look at in 2013, the entire asset base of NBA 5 is about 684 million. However, within 6 years, it has increased rapidly to about 1.4 trillion. So during the same period, the loans and advances of MBSI has gone to 1.1 trillion from just 521 billion. So it's a significant growth that we have recorded in our industry during the past 6 years. If you look at our main products, in the front of leasing, the lending side is mainly leasing, gold loans, microfinance, and no other loans. 53% of these lending represent leases and about 5% on gold loans. So the balance is purely on the different type of loans that the MBFIs are giving. So there are companies that specialize into particular lending product. So example, there can be there are two to three companies who are specializing into microfinancing, and another 4 to 5 companies like specializing into motorcycles. Some companies may be having specializing into loans. So every company has this niche that is they are playing. Apart from the other leasing is the more prominent product that every NBFI is working on it. So that's how the lending structure, the asset composition that has been structured in NBFI. So if you look at on the liability side, 55% of our funding comes through deposits, and the 30% is through by your borrowing. It could be from banks, other financial instrument, or it can be also foreign funding as well, because there are few finance institutions that has taken foreign funding lines as well, and the balance 15% is the shareholder capital. So deposits is we can categorize, like in a broader sense, we can categorize to institution, the fund manager, the unit trust that invest their money, and also the HNIs. Also play a key role, the investments are happening in the form of deposit, and the general public. So the general public is where the more quantum is coming. So each segment has their own way of evaluating method of investment. The decisions are being different from these three segments. Like even in the general public, the majority, there is quite a number of the general public fall into the senior citizen, where they invest some money because in the fine industry pay the attractive interest compared to the bank, so that because the senior citizens, part of their daily monthly income is derived from this interest income. So that's a significant component that is coming in. When you look at our branches, about 66% of our entire industry, the branches out of 1,432 branches that is there, 66% of our branches are located outside Western Province. So during this curfew period and non-curfew period, where the curfew is lifted, all these the branches were open for a shorter period. I think almost every company opened the branches for about 2 to 3 hours during the 6-hour curfew lifted period, and from the week before, when the curfew was lifted for the 21 branches, now the entire branch network is operating from as usual from 8:30 to 5. And as well as there are some few NBFIs open their selected branches, I think key branches, even in the Western Province in some of the days. So there had been a 2 to 3 hour operation that was happening in some of the areas of some of the NBFIs. So that will help to facilitate the depositors and other moratorium requests that will coming in. So that's how the bank, the NBFIs were operating during this time. And we have seen, especially in the outstation branches, where we have opened the branches, even in the few branches that has been open in the Western Province as well, with even despite the curfew is be there, we see that there is quite a number of lending customers coming and paying the rentals. So it's a more positive thing that we have than we have anticipated. So there is quite a amount of collection that is happening as well. At the same time, there is a number that has come submitting a request, moratorium request. So all the branches are being cleared, and all our staff have been, the member companies' staff have been educated on the moratorium guidelines that has been given. So accordingly, the staff members in our industry advise the customers and collecting the moratorium request at this moment, because at this point, what is happening is collecting moratorium. Originally, the cutoff date was yesterday, so I am yet to get the figures up to the yesterday, but we have seen last few weeks or the last few days, the request has increased. The numbers has increased with the curfew has been relaxed in the outstation branches. So I think from this point onward, the companies will evaluate all the requests in line with the guideline that is being issued by the central bank, and to see how best we can help the customers in industry, because as I correctly said, our industry is the industry that is catering to the micro and self-employment. So this is where if you look at the direction, it's the circular itself, the circular is purely try to help the micro and the self-employment. So that is where, as an industry also, we are trying to see how we can support our the customers. So we think that there is a significant amount of that will come in as a moratorium, but
Roshan, if I can interrupt you and ask you 3 specific questions. do you have a sense what percentage of your total loans will come under moratorium? Just a guesstimate.
Yeah, little too early to tell because the data is still coming up. Most probably, I think about 25 to 30% requests might coming in. So that is our gut feeling because earlier we had about the indication was about 20 to 25% the way that the request is coming in. So since the period has been extended to 15 May, so there might be a slight increase. So might be between 25 to 30%.
Okay, 25 to 30%. Second question about pawning. I think there has been a reduction. The regulator has set a direction, I think 12%.
That is only to the bank, not to the NBFIs.
That doesn't apply to your.
No, not it. Yes.
Okay. And then one last thing about the deposit side, that there is a flight to quality. And the regulator also has put a deposit ceiling. I believe on 1 year it's 10.4%. Can you just brief us some of the challenges you all are having on the deposit side?
Yeah, of course, the rate is one of the sensitive area because, as I said earlier, our customer base, the general public, especially the senior citizen, one of their key income for their day-to-day living is the interest income. So reduction in the interest rate will have some sort of impact to their income. Normally, as long as the experience is if there is the interest premium between the banks and the NBFI, if it is maintained around 3%, of course, the customers do tend to invest in NBFI. Only if there is this premium get shorter, then of course there is a bit of a shift in the deposits because as I said, the unit trust, the money market operators, fund managers, and HNIs might shift their investment decision based on the credit rating and the interest, the premium that they want. So as long as if there's the 3%, close to some sort of 3% interest differential, that is we can. So looking at the key banks, even now the key bank, HMB, Commercial Bank, Bank of Ceylon, even their published rate is around 8.25 somewhere there. So looking at that, I think still there is a sort of a premium, but if those rates have been going upward, of course there can be some sort of challenging environment to the NBFI industry on maintenance.
So if I can quickly summarize what you said, that you want about a 300 basis point premium above the big banks. So that should come to about 11.5, while it is 10.4 the ceiling, right, for 1 year.
Yeah, at this moment, yes, correct.
And is the industry experiencing any pressure from withdrawals?
It's a mix of the things that is happening. When you come to the general public, up to now there has not been that much of a pressure, unless, as Jonathan mentioned, there is some sort of withdrawal that is happening. Maybe because of the people maybe having want to have the liquidity in their hand at this point of time, because a lot of day-to-day transactions are happening on cash, not on credit and credit cards. So that may be one of the reasons that can happen. But some of the companies might have a bit of challenges with some of these fund managers might want to take on.
There is a shift. The wholesale funding lines are drying up. Right.
Yeah, there can be possibility because that also has a bit of as I said, the interest premium that they expect also might coming in. So as long as if you can have some sort of a decent interest premium, then again we might get back those bulk money.
Okay. Thank you, Roshan. Over to you, Manil. If you can give us an overview from the standards about some of the issues pertaining to the discussion today.
Thank you, Murtaza, and I think it's good afternoon, ladies and gentlemen. You just crossed that line. Just to start off my presentation, I would like to sort of give a backdrop of where we are. We are now in the economy where, for example, IMF is projecting that most of the major economies are going to have a contraction, and maybe the growth rates are going to be negative 3.1. It's big economies like United States, Japan, India, and think places like that. When you come to more local, if you look at Sri Lanka, we were expecting, I think, GDP growth of around 3.5 to 4% for 2020. Now, this is likely to get contracted to 0.5 according to Bloomberg, but I think yesterday the governor said that this will probably stabilize around 1.5%. So that is one thing. We have also certain challenges in our economy. I think yesterday at a presentation, the governor mentioned that out of our expenditure, 39%, close to 40% is on interest payments. He said salaries account for about 30%. This is government expenditure. Then we have external debt to the tune of 6,400 billion. And of course, we have foreign exchange reserves to the tune of about 7,600 billion. So this whole new environment has created some challenges. Our main sources of foreign exchange came from tourism, remittances, exports, primarily garments and tea. Now, if you look at my previous statement, when I said the world markets, the main economies are going to have contraction, some of our export markets per se were those key markets like US, Europe, and places like that. So there is some impact that could have, say, for example, in our tea, one of our key markets are Middle East also. Oil prices are coming down. This could have an impact on some demand aspects to these areas. But though I say that now governments are also going to impact, but on the other side, there are some positives also. Maybe our traditional garments are getting impacted, but there are new things like now there is more demand for face masks and personal protection type of items. So we believe that these things can, in the short term, it will get changed, but it will pick up. One of the concerns that he mentioned was that we are likely to have underemployment as well as unemployment. And he mentioned that there is going to be some form of a gap between investments and savings. Now, all of these things, I think as the previous speakers, Jonathan as well as Roshan mentioned, there can be impacts on cash flow in the shorter term at least, right? So one needs to keep that in mind before we sort of get into the accounting area. So just to give a backdrop of the environment that we are trying to apply accounting and trying to interpret some of these standards. Though I say all this, there are also opportunities. I think banks will probably have to relook at their books, loan books and places like that, relook at strategies, because there are going to be opportunities. I think the agriculture sector is going to show one of those opportunity area, and Governor also mentioned yesterday, new technologies in agriculture. He also mentioned something very heartening, which I felt was very valid. He said that people who had shunned agriculture, especially the youth, seem to be going back into agriculture, which is a good thing. The restrictions in imports have also created the demand for certain industries to come up domestically to probably address the void or the gap that it's creating. So there are some positives in this whole equation, and I think one, I'm not too sure whether Jonathan or mentioned about medical equipment, medical supplies. Again, it was mentioned that we are going in for more domestic production of some of these medicines and things like that. So there are some good things as well as bad things that are happening. I think it's a question of looking at what those things are and probably addressing some of them early enough so that the impact on this will be marginal and probably can turn out to be positive as well. I think Jonathan mentioned banks are likely to have a strain on, say, fee income. He mentioned that certain things he can't collect fees anymore, return checks and things like that. But in addition to that, the whole environment is also going to create pressure on fee and fee-based income. There is going to be a certain degree of pressure on the net interest margins. Clearly, your credit losses, there is going to be an elevation in your portfolio risks, which will lead to certain degree of credit losses being recognized. And as Jonathan mentioned about this remote working, yes, we have been doing this for a while, but it never got picked up about electronic banking and things like that. Now it's getting picked up. This also can, expose yourself to certain risks because you're trying to do this quickly. And then doing it quickly sometimes can expose you to various risks and things like that, which is a good thing. It's a good delivery channel, which should have happened a long time ago, but unfortunately it didn't. They always say, necessity is the mother of invention. So the necessity has come and hopefully the invention will take place. The banks also will probably need to focus on greater engagement with their clients. They may need to identify risks in their clients. I think Jonathan mentioned we need to support vulnerability in these clients and basically try and come up with mitigation statistics. Now, why I mentioned all these things are because these are going to have an impact on what you do in accounting. So if you look at SLFRS, now one of the problems or one of the things I've always been harassed about is about accounting standards and why do we need all these sophisticated accounting standards? We are in crisis mode. Do we really need to do these kinds of things? Well, my view is actually we need accounting standards now more than we ever needed because we are in crisis mode. We need to attract investors. We need to give comfort to people about your organization. Now, if you don't have proper information going out to the market, and if you don't have credible information going out to the market, that in itself is going to create a problem, right? Next question that we've been asked is this whole equation about why do we have to go to an expected loss model as opposed to an incurred loss model? Everyone is very comfortable with an incurred loss model. More so, the banks are even more comfortable with the central bank's matrix method of provisioning. The previous central bank matrix method was a very easy method, which basically said if you were 90 days in arrears, you suspend income. If you were 180 days in arrears, you provide 20% net of security. If you were 360 days in arrears, you provided 50%, 540, you provided 100%. Very nice. So you basically deferred your provisions over 540 days. So everyone is very happy about this. And this was incurred loss, which means the loss has already happened. So we are just figuring out how we are going to account for this loss. Then we went through to the what we call the incurred loss, but based on LKS 39, which told the same thing, but it gave a little bit of refinement. But unfortunately, in the 2007-9 crisis, it really reflected that these methods of incurred loss really doesn't show the true picture of a bank's balance sheet, nor does it show the true picture of a bank. The reason why that is, by delaying to make provisions and recognize these, the banks themselves are not presenting the right picture to the public. It prevented the banks from provisioning appropriately for credit losses that are likely to arise from emerging risks. It delayed the results in recognition of credit losses that were widely regarded as too little too late. There were questions that were raised whether provisioning models, including the effect of provisioning on regulatory capital levels, contributed to the procyclicality by spurring aggressive lending during boom period and forcing sharp reductions during subsequent busts. Right? So, given taking all this into consideration, the people or the investor community and the G20 countries basically said including regulators and prudential authorities, they said this incurred loss model for reflecting impairment or losses was not an appropriate model which reflected the actual performance of a financial institution. And that is why they moved into the ECL model, that is the expected loss model. They also said that investors require high quality information for decision making. And they challenged that incurred loss was not necessarily giving that level of information. So that is why they went into the ECL model. I know there is a lot of arguments about this ECL model, the validity of it, why do we need to go there? But it is a simplistic form. All what you're trying to say in the ECL model is, if you have identified there is a significant decrease in your credit, right? There's significant risk arising from your credit. In such a situation, you need to evaluate the loss that you can, the losses that you are likely to have over the life cycle of that loan. That's all it says. So it's basically a timing. You're not increasing provisions. You're just taking what is eventually going to happen and making the provision today. That's all the ECL model does. It does not increase provisions. As I told you, under the central bank, you were given 540 days to make that provision. All what the ECL model is saying is, you make that provision now, not wait for 540 days. Now, even the central bank guideline, I think people misread that guideline. They only went into the rule-based provisioning, but there were guidance in that guideline which said you had to look at the future. Now, if you look at the simplistic thing, if you take the 180 days, it only says to provide 20%. It says you must provide at least 20%. But at the 180th day, if the bank felt that they are going to lose the 100%, they were expected to provide the 100% on the 180th day, which many banks probably didn't do. That is there in the guideline. I think if you read that guideline, you will understand. It's just that I think people cherry-picked what was relevant rather than really taking the whole essence of this whole guideline. So I hope I have sort of cleared this whole area about the standards and why the ECL model and things like that. Next thing that probably we need to address in this whole equation of accounting is this whole question about accounting for Circular 5 and the relief measures that have been given. So two things get thrown out in this whole relief measures. The first one is about interest recognition during the relief measure, relief period. There has been a lot of arguments about this. We are not going to get interest for the next 6 months. Should we account for interest as income? Now the question is, these relief measures are applied to performing advances. We will not take the non-performing. Non-performing, you have anyway not recognized interest. But for performing advances, if you are saying that you have deferred the cash flow collection, now can you say, just because you deferred the cash flow, these have become non-performing? No. So if they are continuing to be performing, then clearly you need to account for the interest. That doesn't mean you're going to receive the interest, but you have to account for the interest when it's coming from an accounting perspective, right? Because they are non-performing. Because they are performing advances, and the relief or the moratorium is applied for the performing advances. So that is one aspect. So next comes to the next aspect. What is the interest that you need to recognize? Right? So here, the standard basically allows you to evaluate and tell what is this moratorium, what does this moratorium tell you? So there are two ways to look at it. First of all, the one that I'm quoting is this is the understanding, but this doesn't necessarily mean it is an accepted norm. Accounting really follows the structure. It does not follow anything else. So accounting can't dictate the structure. It only follows the transaction. So one school of thought is that under Circular 5, that during the moratorium period, no interest should be charged. That is one school of thought, right? If that is the case, what happens is you have pushed the cash flows by 6 months. Because the Circular 5 says that you must collect the money, you must attach or extend the period by an additional 6 months. So you have pushed the cash flow. So first 6 months, you have pushed the collection, and it is silent about whether you should collect the interest or not. Circular 5 is silent. So two options. One is you collect interest, one is you don't collect interest, right? So I will go on the basis, if you don't collect interest, what happens? If you don't collect interest, the standard now comes and says, there are two options for you. From the original loan, you have now done a modification to this loan. What is the modification? You have extended the time period for repayment. So that's the modification. So now you have to evaluate whether this modification to your original terms or original loan is significant or not. If this modification is considered to be significant, then it ceases to be a modification and it creates a new loan with new terms. That's one option. If the modification is considered not to be significant, then it prescribes what the accounting should be. So what the accounting should be is, you take the revised cash flows, discount the revised cash flows based on the original effective interest rate, right? And you will obviously get a value. You compare that value with the carrying value of your outstanding or the debt, right? And obviously, when you do this calculation, you will find that your discounted cash flow is lower than your carrying value of your asset. Now that differential becomes a day one adjustment, which means that loss you will have to account immediately. That is if it is considered to be a modification. Right? Now, as I told you, if that amount is significant, then the standard goes on to say, no, then if this whole restructuring gives a significant impact on that loan, it can't be a modification, it is a new loan. In such a situation, you de-recognize the old loan and you recognize a new loan under new terms. So the new terms is, you don't have any payments in 6 months, and then you have a new period under which you have to collect the money or the installments. In such a situation, you now put the same cash flows and you work back and find out, based on these new cash flows, what is the new EIR. So clearly the new EIR will be lower than EIR, being the effective interest rate, is clearly going to be lower than the original effective interest rate. So if that is the case, you use the new EIR, which means it will be a lower number over the period of the loan. So in a nutshell, if I put it, one method is the loss is recognized immediately. In the other method, you recognize the loss over the term by lowering your income. So that is basically what the accounting treatment would be for interest recognition of this moratorium. On the other side, if the other view is taken that during the period of the moratorium, you can collect interest for that period of 6 months, then the likelihood of the impact of that whole equation would be marginal in my view. Because you're going to collect it, but only thing, the interest that you accrue during that 6 months will be collected at a subsequent time frame. So there will only be a time value of money adjustment for those, for that, depending on how you structure the collection. Whether you structure the collection at a lump sum after the 6 months, or whether you structure the collection of interest over a period of 12 months, it all depends on how you structure that. So basically what I want to tell you is, the accounting treatment follows the structure. So you just can't give a off-the-cuff treatment. So once the structure is known, you can apply the accounting to that. But basically, it follows the cash flow patterns in the restructure. The next issue that I would want to sort of dwell on is what are the challenges that Circular 5 brings about, plus the COVID situation brings about how you determine impairment. Now, there I would like to just say there is a slight variation between what the scheme that was offered for Easter loans and what Circular 5 says. Now, Easter loans, very clearly, they had mentioned that the amount that is payable during that moratorium period will be converted into a new loan, and the new loan will attract a certain amount of interest, and that will be paid over a different period of time. So if you have that kind of a scheme, as I said, the probability of you making any losses upfront or over the period is, I would say, minimal. Circular 5, as I told you, is silent about this. It talks about postponing the cash flow, but it doesn't talk anything about, at least not to my reading of it, it doesn't not talk about anything about collecting interest on these facilities. So it all depends on how you want to interpret this, right? So there is a difference between the two. Circular 5 also brings in new challenges. Now it says for you to postpone the collection by 6 months. Now what the standard says is, just because you postpone the collection by 6 months, that does not give rise to significant increase in credit risk, right? You have to evaluate the whole relationship and figure out, in this particular client, in this particular industry, in this particular business, by doing this, am I going to increase my credit risk? In most cases, you won't. So therefore, the moratorium will not result in an increase in credit risk. However, actually, in some cases, the moratorium might even help to resuscitate certain businesses that were going down, right? Because by giving them time, they are able to restructure their business by taking into account this whole new scenario that is taking place in the world. Maybe they can be better. Like as I told you, agriculture may be in a case in point. So all what the accounting says is, you need to evaluate all these situations. Now you need to evaluate the new situations under consideration. So most of our banks and financial institutions, bulk of their provisions are calculated based on a model. Even in banks, maybe 30 to 40% may be based on significant, they are considered to be significant loans. And then for those, you actually predict the future cash flows, whereas more than 60% of the portfolios are calculated based on a collective basis. That means you apply a model. Now, when you apply the model, this model has certain assumptions. You have to work out what is called the probability of default. In this portfolio, how many loans are likely to default? Then you have to work out, at the default of this defaulted loan, what will be the recovery, what will be the loss, which is the loss given default. Now, these are things that you have to work out. Now, so far, when we work this out, we have worked out based on historical data. Now, all of you all will realize how representative or how reflective is the historical information in the new normal scenario. So clearly, these models have to be relooked. They might have to have new staging. So we went on the staging based on 30 days, 60 days, you move from stage 1 to stage 2, 90 days, you move from stage 2 to stage 3. Now there are moratoriums and certain reliefs given. So will the staging 30, 60, 90 still work? Or should there be a different staging intervals? Right? So these are things that you need to look at. Then the loss given default also. When you are calculating the losses, can you consider, now you have a portfolio and you have portfolio infection. Now, can you consider losses arising primarily only from COVID? Can you expand that and apply to the rest of the portfolio? So these are things that one would have to exercise judgment in developing these assumptions and estimates. LGD, that is loss given default. Murtaza mentioned about the property market. Now, it will clearly have an impact on collateralized loans. So when you calculate your loss given default, do you calculate based on the previous recoverable rates, or are they going to get impacted? I would further add, under again Circular 5, there is some relief being given to say that you have to postpone taking parate action. So which means you might have to postpone the cash flow recoveries from securities. So these can have an impact on your loss given default calculations. The next issue is, now in the past, how we did was we took all this historical data. In order to make it future, we brought in something called an economic factor adjustment. Now, in determining the economic factor adjustment, we look at certain things that are going to happen, certain predictions, like what is your prediction of GDP? What is your prediction of unemployment? So we then correlated those predictions to what is happening and basically estimated this economic factor adjustment. Now we may have to revisit that, and that factor adjustment was done under 3 scenarios. There was the most likely scenario, there was the worst case scenario, and the best case scenario. So we gave certain weightings for these scenarios. Now we might have to weight that more towards the most worst case scenario than the best case scenario, because things are going to be a bit more difficult in the future. But there again, you're going to have a problem, because you don't know how the relief measures that are given by government is going to impact on these numbers. So immediately there will be a certain degree of uncertainty as to how to predict these numbers. But I think as time goes on during the year, we will get a clearer picture of how things will work out. So these are areas that one has to focus, because you should look at the industries. Some industries will be stressed, but on the other side, there may be other industries which actually give a benefit or might even perform better. The last point I have to touch on is about, I think Murtaza very eloquently presented in his opening remark about the international sovereign bonds and the Sri Lanka development bonds. These are foreign bonds. Now, there are some situations that are coming up. I think he mentioned one thing is about the fair value or the traded prices of these. In the international sovereign bond, certain tenors, you found that you were only going to get 55 cents on the dollar, right? In some cases, it was not too bad. It was about 80, 90 cents, but in some cases, it was bad. Now, in this whole equation, is this a fair reflection of the price? Is it a fair price? It's a traded price. It's a market price, no doubt, but is it a fair price? So that is a question that one has to ask, and whether, if it is not a fair price, again, the accounting tells you what to do. If it goes and tells you, then maybe you have to look at deriving a fair value rather than just taking the market value. Because if the market has been acting under stressed condition, a forced sale market is not a fair market, right? So these are things that one has to consider. One also has to consider, now I know you all must be knowing, Sri Lanka has been downgraded. Now clearly when you downgrade a country, the bonds which are valued based on the rating, your probability of default is going to get impacted, right? Clearly. Now the question is, what do we do? These are sovereign bonds. So far as we know, Sri Lanka has never defaulted, and I hope we don't also, because again, listening to the governor's speech yesterday, even though we have, I think about 3.2 billion US dollars which are coming up for repayment, they have a plan of action which they are going to meet. And if there is any shortfall, according to him, he says that there are enough reserves to meet those obligations for this year. But we also have to look at next year and year after next, because there is quite a bit of redemptions that are going to come in those periods. So clearly the downgrade in the country rating will have an impact on the valuation or the fair value or the impairment for bonds, especially international bonds. One of the other concerns that we have is SLDBs. SLDBs are primarily subscribed by local banks, and they are not very, how should I say, actively traded. But the local banks has a lot of insight or inroads into the SLDBs. The next question is, do we take the ISB valuation to be representative of the SLDBs? So these are issues where judgment has to be exercised, and in exercising that judgment, we need to be aware of what's going to take place and to exercise the right judgment. The accounting standard per se gives various options. It gives a certain degree of flexibility to ensure that the current situation is represented in the financial information that you present. So with that, I think I've covered, and maybe, I don't know, that I've gone over the limit.
Yes. Thank you, Manil. It was professorial, your coverage. We'll come back a very technical area, but I think you adequately covered it. Over to you, Yvette. I mean, there's a lot of questions that are coming related to the regulator, which I will tell you after you speak. Thank you for patiently waiting. Perhaps you can give your view as a regulator of how you see this COVID crisis impacting the industry and some ideas going forward. You may need to unmute.
Okay, good afternoon, everyone, and thank you very much for the opportunity given. Of course, we have been listening for over 1.5 hours now, so I hope you'll have patience to listen to me also a little bit. Though we are in COVID-19 today, to start with, I would like to take you back to 70 years back. Now we are celebrating the 70th anniversary of the Central Bank of Sri Lanka this year. But just to tell you, the explanatory comments that was made by our founding governor when he recommended setting up the bank supervision department within the central bank, I quote, "Banking is an economic activity which affects the public welfare to an unusual degree. It touches in one way or another almost every phase of a country's economic life. Sound banking is essential to healthy and vigorous economic development. Supervision of banks helps to protect the public against mismanagement, bank failures, and loss of confidence in the banking system. It helps to protect depositors and stockholders, of course today it is the shareholders, against loss, and frequently enables bank directors and officers to manage the affairs of their banks more wisely and intelligently." Unquote. So though these are words that mentioned 70 years ago, I think this is very valid and very relevant to the topic of this forum. And I think it provides the thrust of today's discussion. So that is why the role played by the bankers, the finance companies, and on the other hand, the central bank is so important, even in a situation like this. So we have no escape. We have to ensure that at the cost, whatever the public welfare is met to that unusual degree, while ensuring our institutions are also sustainable for the long-term existence to provide the safety of the depositors' funds. So with this opening remarks, we've heard the background of our banking and finance system. Then we heard how currently, because of the COVID-19 situation, how the banks and finance companies are going through it and what they intend and what are the opportunities. I'm happy to hear that you all are discussing about this change in business models, because though COVID-19 did not exist, these are things we've been talking for so many past years and have been discussing. The boards have been going through these things. So it's another opportunity for all the boards of directors, again, to sit and revisit the business models. And as explained, there are many opportunities. So the lead if you take the lead, I think you are at the correct pace and you will win over. Of course, now if I come back to the relief measures, I'm sure that is the most important thing that we need to discuss. So I'll just I think the central bank, how once the government announced these relief measures, how we looked at it was, yes, it was announced so immediately. And the intention of the government was that there is going to be a slack period in the country for some time. And therefore, there is going to be some form of standstill that's going to come. So we should ensure that people don't get agitated. There is not going to be a social disharmony. There's no that kind of a disturbance. So to ensure that public welfare is provided to that unusual degree that is expected by the banking system, and of course, lately the finance institutions also, these relief measures were formulated. So the thinking was, by giving this early relief to our borrowers, they will get that comfort that there is some relief, and they will think about how soon they can come back to their normal. They will plan about it. They will then kind of work towards that. And then once things are falling in place, they would be able to slowly get back to their normal and then continue the normal business environment. But I know these are, as mentioned, not only in Sri Lanka, world over, these are very unprecedented times where the shock is unbearable and it's not within our reach. So therefore, this, I think the 2 months to 6 months debt relief was because of that. But there again, the government identified different groups. Those like SMEs and those who are more affected were given a longer time. The salaried, the monthly wage earners were given a shorter time. So like that, there was some structuring in giving these moratoriums. So the intention was, as I said, to help them to manage the immediate. But that doesn't mean that it is forever. And I want to say this debt moratorium is only a mere postponement. It is not that a waiver. There is some discussion about the interest waiver, how we see is there is this postponement which is going to get repaid by extending the loan period from the equal number of debt moratorium installment. For example, if the moratorium, applicable for a particular borrower is 2 months, and under normal circumstances, if his loan was to be repaid by September this year, he will be given another 2 installments, that is October and November, to settle the same amount of the installment, what he was to be paid in March and April to settle his loan. So that is really maybe a little bit unusual from the normal types of moratoriums or normal type of rescheduling or even the normal business that the banks and the finance companies have been doing. But this kind of unusual requirement was again thought about is again to facilitate the financial institutions. Because if the borrower get the feeling that they are not going to be able to meet this immediate, the installment, the collective installment, no sooner they start paying the loan, or that they're going to be charged interest on interest, which we can say time value of money. So it's going to be different. So therefore, that's why it was structured like this. We have already sent some clarifications, and the accounting treatment also has been explained by the Chartered Institute. So our only expected hope is things should get back to normal, and then we should start business revivals. And with that, while the businesses benefit, the cash flows will start coming in to the banks and finance companies, and things will. Of course, there will be hard times, maybe the next 6 months, as was explained, because you may have to pay your depositors interest. There can be certain withdrawals. You have to meet the urgent and essential expenses. But in the meantime, you are not getting your normal income. Yes, there will be hard flow. So in that sense, I think you all are already aware, there are ordinary regulatory measures that have been taken by the central bank, which was outlined by Mr. Jafferjee, which shows you certain capital buffers. Of course, capital relaxations will not immediately give you the liquidity, but then there is capacity for lending there. But liquidity also, certain liquidity measures, like for finance companies, there have been certain reductions in their liquid asset ratios. With regard to banks, also we are also looking at that some relaxations in the few ratios that we have been looking at, and that will be announced soon. So in addition to that, there are so many other regulatory relaxations when you think about the NPL treatment, then how you are going to treat other loans. Then we had something called 30/70 rule, where you had to look at the collective non-performing loans and then make some provisions and then classification. So these things have been relaxed. And very importantly, the interest rates also have been coming down. So that should really give you a lot of comfort, because it is not reasonable to charge these same interest rates when we come for new loans. So therefore, then with regard to the deposit rates, for banks, we have had deposit ceilings at the beginning of last year, but then it was not very effective, and therefore we switched over to the interest caps, interest reductions on the lending rates. So there were some timelines given with some targets, so that interim target has been achieved. But then we are supposed to review it. We were supposed to review it by the end of March, which I am sure our Director Economic Research is doing. And we may look at certain other requirements because interest rates have come down further. So we will announce those in time to come. The recent reduction in the pawning interest rate was really again looked at to facilitate our low income group, the customers, because we know the pawning is one of the advances that they always make use of for their day-to-day needs whenever they have some shortfall in their cash. So in order to ensure that they meet that cash requirement, but later on they are in a position to kind of again get back their valuables by paying affordable interest, this reduction was made, because anyway the rates were somewhere between 12% to 17%, and the majority were, at least the banks that are providing the higher share of funding in the economy, they were more skewed towards the 12 to 12.5%. So that is why this reduction was made. And we hope the finance companies and also the pawnbroking shops that are operating in our country would also take some hint out of it and make it more affordable to their customers. Then, so in that sense, I think there are now, as the topic suggests, the concern is with all these things, will the banking and finance sector remain sound and strong? So I think the central banks, the main whole idea of regulation is to ensure that. So before this COVID-19 happened, also there have been certain disturbances, slowdowns, then NPLs rising, as shown the earnings coming down. But this has really probably brought down a complete stall to all those ratios. So we have to start working on it. We are mindful of it. In fact, with regard to banks, I know our bank examiners are having on a daily basis one-to-one discussions to recognize, to identify what are the issues they are facing, what are their future liquidity requirements, how they are managing, are their contingency funding lines working, or are those are getting dried up? How are the foreign currency borrowers responding to this situation? Are they in a position to roll over those? So I'm happy to note that bank officers have been very kind of attending to these things and looking at their cash flow situations, trying to kind of work out new contingency arrangements. So I think along with the central bank working together, we should be able to go through this difficult time. But from the central bank's point of view, the Monetary Board also has looked at several options that it is available to the central bank. And with regard to the finance companies and the leasing companies, already announcement has been made. Certain funding requirements have been looked into and has been earmarked. So those things are there. And for the banks also, we have made an announcement that whenever you need your liquidity, that will be provided by the central bank. In fact, in the Monetary Law Act, there are certain provisions where the central bank can provide the funds that are needed for credit expansion and also for the sustenance of the banking system. And where it is needed, certain mortgage loans to be provided. And if it is needed, certain, now we have already started, the refinancing facility is already there. I know it may not be sufficient, but the central bank has given some guidance how to manage it. As was explained, it is not the normal working capital requirement that is targeted at it. It is just the survival or sustenance of the immediate 2 months, but you have to look into your other funding arrangements or making use of some reserves that some companies have already built up. Those are also there, so where you can make use of them to start business and business revival. So similarly, we also have our liquidity, the support scheme, that is the deposit insurance scheme, which is about 62 billion at the moment. And some funding has already been given as payouts and also as some loans to the certain finance companies. But that funding is also there, which accrues about 19 billion for a year. So that fund for any urgent, immediate liquidity needs. These are not for solvency requirements, but for liquidity needs, that funding also available. So what we want to kind of give comfort to the banks and to the finance companies are, because of the COVID situation, and also because of this result of these relief measures, if there are going to be some discomfort in your liquidity situations, by regulatory relaxations, we have given certain relaxations and we are working on some more. But also in form of liquidity, the central bank is also ready and have already looked at the available provisions and the ability to provide this. So I think what we have to do is to work together to be more interactive, provide the information that is requested on a day-to-day basis. Now, for example, we requested banks to provide us some information on some stress testing. That is, we gave them some scenarios. Suppose you are not going to get the entire loans that are on moratorium 100%. If it is 20%, if it is 15%, what are the numbers? So we have done some stress testing like that. So still it is too early, as was explained, for us to look at the exact situation, but we can always work on these scenarios, and we have ideas. We have done kind of stress testing to get the feeling, and then we are working on having certain processors being made available in case situations arises. We will definitely facilitate banks as well as finance companies. So I think that is the assurance I can give. But to talk on a few other things that were mentioned, Mr. Alice mentioned about this currency giving more opportunity to deposit. I think everyone is aware that it was a 5-day exercise that under normal circumstances, but because of the restricted staff and the restricted working environment, the currency department currently has 3 days per week. Of course, last week it was 2 days because of stock taking requirement, and probably next week also it may be 2 days because of the holiday. But otherwise, 3 days we have tried our best to accept your deposits and provide you with the necessary currency requirements. Then regarding the accounting, now this expected loss model is something new along with the new accounting standards. But I must say the Central Bank of Sri Lanka has almost practiced that same expected loss model as was explained by Mr. Jayesinghe from way back in early 1990s in our normal rules of classification of loans and income recognition. So as was mentioned, there is this part of potential risk. Even if a performing loan had a potential risk of not being recovered at a future time or due to some other reason, then there was a requirement either to make it to a different category or to have an extra provisioning on that. So it's just that banks very comfortably only took that rule-based one and did kind of, in most instances, just did not bother to take this part. But of course, whenever our examiners go on examination, when they do their sample testing, this is an area very vigorous examination is done, and we are take action to require the banks to provide more. And that is how over the years certain buffers have been built up in the form of provisioning or impairment or whatever. These buffers have been built up. So that is why we are in a comfortable position to release certain buffers and provide the facilitation to the banking system, similarly to the finance system, finance companies also. Then on the interest rates, Mr. Abeygoonewardena mentioned about this 300 basis point differential. That is also something we have to look at. We know the bank rates are generally lower, but then within the banks also there are certain categories of banks that have slightly higher rates. Sometimes that depends on their appetite also. If they don't wish to have their long-term deposits, they would not have those attractive rates. But if they only want maybe probably based on their liquidity requirements, short-term funding, then they would have slightly higher rates. So as I said, the central bank will look at the 31st March position and the overall interest rate position. And we will try the best to provide that comfort to the finance companies. But on the other hand, I am sure so many depositors are also listening to this forum. Just because of a 25%, 50%, 25, 50 basis points, particularly at this moment, please do not providing very well at this morning of this to come. I think it is going to have a bit of a further difficult situation to our institutions. I know your incomes will also come down because interest rates are coming down, but we have to.
Sorry, your connection got affected when you started speaking about the assurance to depositors. I think it's the leading question that is coming up. Can you rephrase that again, please?
Yeah, is it okay now? Can you hear me?
Hopefully the connection will be strong. Go ahead.
Okay. Now, what I mentioned was as depositors, there is a bit of important role to play. Now, there is sometimes tendency when there is a small shift in the interest rate for us to shift our deposits from one institution to another. So what I mentioned was particularly at this time to kind of give you a cooperation also, as has been happening all the time, not to do that kind of a shift because of the small changes in interest rates, because that really destabilizes the system, and kind of large withdrawals in that form can also kind of further aggravate the situation that was explained by the banking and the finance company CEOs. So therefore, that's the request I made, but I know the interest rates are coming down, so the depositors also will face it difficult. But I think this is a time where all of us have to make a lot of sacrifices. We may have to sometimes sacrifice our own interest in the by prioritizing someone else's interest, because certain priorities also have to be made. Everyone cannot be given the same treatment in this kind of situation. So these are some collectively we have to go through this. So certain guidance, I think, given in our relief measures or in our refinancing facility, targeting at SMEs, targeting at the companies that are giving more opportunity for production and employment, some guidelines like that. But I'm sure in time to come, we have to have many more, much wider kind of attempts like this, and that is what the government is also working now. So with that, I think I will stop. I'll be happy to take any other questions.
So Yvette, there are a few issues that I want to take up. The leading question that's coming up on Slido is naturally they're asking what measures is CBSL taking to ensure that depositors are not compromised and not eroded by government action. Banks are custodian for depositors. And then another question, is it that lobbying on behalf of borrowers are far more organized than depositors? So the depositors who represent every strata of society is ignored. So it's more a safety angle, and I think you talked about the soundness of the system, but would you like to make a very brief comment that what your focus is on depositors or soundness of depositors?
Yes, I think the whole exercise of regulation and supervision, as I mentioned, is the interest of the depositors and also other creditors. There are a few other borrowers also. So otherwise, there is the regulation and supervision will not exist. So over a period, we have built up certain buffers. So that is why we were in a position to release these buffers to give way for the banks to make use of it. But on the other hand, we also need to know that if this doesn't happen, and if the borrowers are not allowed this facilitation, they would not be able to repay, which will directly hit again to the depositor. So it is like holistically, we are doing this holistic exercise. The ultimate benefit is going to be to the depositors also. And as I said, we have the deposit insurance fund. We have certain credit lines that are available under the Monetary Law Act. There are certain emergency lending facilities. So I think we are totally mindful about the interest of the depositors, and that is the core one of the core objectives of the central bank, to maintain the stability. So if the depositors get disturbed, it is going to create a lot of instability.
Right, and the reason why the interest rate structure is being brought down is because obviously the economy has slowed, but it's also to improve. Is it about improving affordability of borrowers?
Yes, definitely, because the cost of funding is then expected to come down, because we have seen about 200 basis points reduction over the past few, starting from the end of last year. So that is the transmission mechanism. Of course, it happens with some time lag, but repeatedly banks have been requested to do bring about this the reduction. Generally, the deposit rates are reduced much faster, and we have seen it happening as you showed in the new deposits. But if it is to be made affordable, and if the system to restart and get revival, I think new lending rates should also come down.
Okay, the next question, Yvette, is about the deposit guarantee fund. Basically, does it guarantee deposits up to 600,000 rupees?
Yes, 6,000 per person, per institute.
That's 600,000 rupees per institute, per depositor.
Yes, so if he has 1 million deposit, he'll get 600,000.
Okay, okay.
He has several deposits account into 5 million, again he gets only 600,000.
You wouldn't have a number that would say how many depositors in the system are covered under this scheme?
Of course, at this moment, we are still kind of building up. It is not a very significant amount.
Right.
Internally, we would have the numbers, but unless it is publicly available, I do not want to divulge at this stage.
Oh.
It is not a significant coverage at the moment.
Okay, not a significant. Right. Then basically 2 questions that have come up previously. It's coming about this Circular 5. Now, there are questions coming up on Slido and even on the Zoom. Now, this postponement, the moratorium, the example that is given of equal monthly installment, some people say that, some banks are saying, no, we are going to accrue interest. And you say that, no, by postponing it, it's only the interest on interest component. Can you reiterate again, what is the stance? Can they accrue interest? Is this a directive? Is this a directive or a recommendation?
Now, in the circular number 5, dated 27th March, if I read this requirement, it says in section 3, item 2, financial institutions shall extend the existing tenure of loans eligible for debt moratorium by the respective moratorium period. Now, these are for term loans. So what worked is, I think I explained. Now, if a person was paying an installment of 25,000, and if his moratorium is he's eligible for 2 months moratorium, that means for the months of probably March or April and May, he would not pay 25,000 to 25,000. So if his original loan was to mature in September, now after the September, he will be given another two installments. That is what we meant by extending the loan period by the respective moratorium period. And at that time, he will pay these 2 installments of 25,000.
Okay. So the obvious question is that there is an opportunity cost of those.
Yes, time value of money, yes.
Yes, and that basically the financial institution.
Yeah, but then there is this statement also that there is an interest waiver. I don't know whether you can call it an interest waiver, because that due interest with the capital is being collected at the end of the period by adding on additional installments.
Okay. Jonathan, you have a view on that? The opportunity loss of those 2 installments in this particular example, can you live with that?
No, definitely they may not be able to. It's difficult. There is a loss to them, but we have to look at the whole picture and see what would have been the other side of it. If the relief measure was not there, if people are just allowed to pay as they wish, then I think that is why the government intervened and with some purpose. So we have to look at it in that sense.
So Yvette, is this a directive or it's a request?
No, it is not a request. It is in our circular. And as I said, it says financial institutions shall.
Okay, shall.
So that is our form of direction.
Okay, so Jonathan, as the Bible says a lot, thou shall. So it doesn't look like you have a lot of options.
So I think, as very clearly explained by Yvette as well as previously Manil, if it is a short term, like she said, 2 months or whatever, it's something that we can absorb. We have been doing moratoriums in the past, and then when the interest component is significant, some customers paid bullet, some in a month, 3 or 6 months, and that's something, you've given them interest-free loans in order to pay this interest. Otherwise, it will tantamount to interest on interest. However, I think the problem arises if suddenly you've got to give much longer time, like if it's a 2 years or a 3 years, then it doesn't become workable or sustainable, because you're talking of shareholder funds, you're talking of depositors' funds. At the end, there is a management structure or a governance structure within banks as well, in order to manage their balance sheets, their assets and liabilities. So this 2 months and stuff like that was mentioned is very manageable, and we have enough of experience of doing that. When it crosses something like a 6 months or whatever, then it becomes untenable, and you need to look at how do you fund that holding or that interest cost or whatever, which can be quite significant.
Alice, it's from 2 months to 6 months. So now if we are confining to this circular, you only have to follow this. But after the 6 months extension, if the customer is unable to pay, then it is a matter for you to deal with the customer, agree on your normal terms, that is right. But what we have specified here is the person who agrees to take the moratorium to give him this facilitation. But if he comes and tells, sorry, I can't pay these 6 installments as was mentioned, then you have to discuss with him and have your normal banking arrangement. That is okay.
I agree with you 100%. We are, as an industry as well as I think as a bank, we have been consistently doing that up to that 6-month period. We will support this initiative. But others we will negotiate separately beyond that time.
Yeah, but I think there is a tendency from your branches to have the first priority to ask for a interest. So you need to educate your branch managers and tell them the first priority should be to get the customer to pay the 6 installments during the extended 6 months, so that he as well as the bank benefits. Because if you go for a longer period, even though you are going to get your interest, it is a longer term where you are going to get your liquidity back. So that they do awareness, and also maybe something kind of a circular needs to be issued back to your branches, because we are getting a lot of complaints. And the first thing, these customers, because we need to understand these are customers who are performing. The majority of them were very very constantly paying their monthly interest payment. But now because of this extraordinary situation, this has happened. So the first question they ask us is, does it mean that we'll have to pay interest on interest when we start repaying our loan after the moratorium? So that is the situation we have been trying to address. And as I said, please educate your branches also to facilitate in, take it in this proper context and do the operation. Thank you.
Yvette, now when I don't have the numbers, now you're given 2 months to 6 months, and then you have different types of borrowers and different products, etc. If you do an opportunity cost calculation, which will be the most expensive for the system?
Now, I think in the already some numbers have been, I think the Chartered Institute also has worked up on certain values, and certain numbers have been shown as examples, but the exact figures are not available. So what we are telling is, now even when we check with some banks, they have worked on certain scenarios, but they were not exactly the expected level. Like they have taken extreme situations, and some people are giving quite a large values as being losses. But when we look at the scenario, because now as was mentioned by both the finance company and the bank CEO, they also have not got many requests at the moment. So meaning still the borrowers are thinking whether to go and get this, or whether we'll be also more benefited by somehow or other paying these loans as they come, and then kind of continuing our business. So that is now without the numbers we can't tell, but there will be a loss, definitely there will be a loss. But by doing this exercise, we are in our working, we had thought of giving them the kind of the minimizing the loss. That's what we meant.
Manil, if I can quickly ask you a question from the 2 scenarios, day 1 loss, or it is over a period of time with lower interest income, where do you think most of the institutions will account?
It depends on the loan tenant. Like for example, if the remaining period is going to be short, let's say 1 year or 1.5 years, then the modification may not be that significant. But if your remaining period ends up going to about 3-4 years, then because you're attaching the 6 months at the end of that whole period, so then your time value gap is expected to be more, because you're financing that thing in a longer period.
Okay, so roughly, basically, it's a product I'm somewhat familiar with, leases. The leases that have been originated newly will have a bigger impact than the older leases.
Exactly.
Okay. Jonathan, have you got your people to work out any kind of scenarios? It's a fairly complicated calculation. You got any sense of what the impact would be to you?
We have done, like was mentioned, if 20% take on, like what you have is like if you take our portfolio with almost close to half being corporate banking and them not being eligible, and a 30% SME and a 20% personal, and only looking at extensions for about 10% of that personal, and almost we have factored conservatively almost the entire SME fraternity requiring the portfolio. So our estimation is a little more than the 25-30% to 30 plus a little is the calculations that we are working on it. Based on that, we have actually modified our projected impairments, and also we have modified our projected cash flows, taking into account these extensions being provided, and therefore repayments kicking in let's say 6 months later or whatever, though the reality might be actually even to further sensitize and do scenarios of those extensions, how many would actually then start paying after 6 months, or would you have to consider further? That's a step that we need to take next. We have only done the initial step of factoring this percentage of our portfolio may actually come for extensions as well as moratoriums, and if they come, what is the impact on the cash flow if they start paying in 6 months' time. I think the next phase is to look at not all of them, while they were current, not all of them were the best in the best of shape, because we are coming off about 2-3 years of a sluggish economy. So all were struggling anyway when we got into COVID. So some of them will take a little longer to get back because they had inherent problems or weaknesses prior to getting into COVID, though they were in the current section. So you need to factor all those in working out your post 6 months cash flows as well, and take a conservative view there.
Two quick questions to you, Jonathan. This came on the Slido. It may be a tongue-in-cheek question, but banking sector seems to have not gone into a pay cut. Will the status change in case there is more directive that will lower bank earnings?
So I've seen, one or two industries where they have actually recognized pay cuts, etc. But what the banking industry is doing today, taking all the risks, traveling with a lot of discomfort, going from branch to branch, doing all their work in order to support the economy and to support everybody in providing extensions, in providing help to everybody in the economy. And to do that kind of extraordinary service and extended service, if they have got to take a pay cut also, it's something. And also how I look at it is, in our own way, we are doing our taking out a day's salary, taking out so many days' salary and putting it into charities and into the right areas. So you might want to think about, why do I take a 10,000 rupees from one of my staff who's struggling to meet, because the banking industry, it's heavily indebted, right? They half of their salary goes to pay their loans and stuff like that. You take a 10,000 out, all you do is you're trying to make the bank richer, which is in turn providing greater opportunities to the economy, which I understand, and which makes rich shareholders richer as well as pays more tax to the government. And this is on a cash basis. You pay your tax for profits that you have actually earned on an accrual basis and not on a cash basis. So at the moment, the industry has not gone there, even though at an individual bank level, these are areas that we have actually evaluated. That we are going to reduce costs is a no-brainer. That will happen looking at each item, where we would try to see what can be actually shaved off in order to record the highest possible returns for our institutions. But at this particular stage, we have taken, fairly significant discounts on our increments as well as on our bonuses. We see this happening at the year end. So we'll probably need to reduce those provisions, etc. So that being the case, at this stage, taking adjustment on the basic is not something we have looked at.
That I think you have clarified. I will come to you, Yvette, in a second. There is a question about this eKYC and digital onboarding. But Jonathan, very quickly, there's another question that has come. As you know, the stock exchange has been closed for 6 weeks. and it's about shareholders. Are you having any engagement from your shareholders, especially your foreign shareholders?
We have been having engagement actually since the tourism debacle, that is post Easter Sunday. It has been continuous. To be honest, the discussions have been even longer than that, from the time the government raised taxes on the industry, the ad hoc taxes and the various other one-offs that were charged. All this has come into play, and they were asking why investors are being treated like this, on the basis that we end up giving them scrip dividends every year, which they are not interested in. They want cash, but we end up giving the government cash on tax, etc. So these are long discussions that we have been having, and even they are very concerned about the moratoriums that we are granting, its impact on profitability, but more than that, the sustainability of the business, the industry, and the ability for banks to continue. We try our best to explain, but they all come from countries where there has been tremendous government support, like 30% of GDP or 15-20% of GDP being allocated as stimulus into the economy to support SMEs and various others. So against that backdrop, when you get a UK investor or somebody coming in from Singapore, Hong Kong, and telling you all this, it's a bit challenging, but then these are the engagements we have been having. Just one other point, we obviously will have similar challenges with our foreign currency borrowing as well, on two aspects. One being, they are looking to retain their monies with them, as with all banks trying to remain liquid. They are taking a feel for, how each country and the banking industry is adjusting to it. So a lot of what we do is being not only looked at by shareholders, but being looked at the overseas banks as well, to see whether they should continue. So we are actually making sure that we have enough funds to make all our repayments on the due date, just in case we are unable to negotiate anything differently. So in this regard, rating and all that matters, because these are all covenants in our loan structures. So the moment, there are changes to rating, and even the KPIs of the banks keep coming down at an industry and bank level, it has an impact on our borrowing, our ability to borrow in the future, and also therefore the borrowing cost as well. You will see maybe going up, which will make it less affordable than to you apply those funds on the asset side.
What about on the trade finance side, corresponding banking relationships? Any questions being asked there? With the re-rating of the country's credit risk coming down, I mean, your trade financing also are creditors, basically.
Yeah. So at the moment, at the short end, we are managing, as well as now that it's being limited to essential services, it's not a question that is coming up. The initial stress is more on the long-term borrowing, which we need to kind of take care of, and then our shareholders. But you brought out an important point. Actually, we didn't look so much into the trade, because volumes have dropped to less than 50% or 30% of what we normally do. When we get back to normal, then we need to see the kind of supply credit and the usance credit, the amount of usance LCs we open compared to site LCs, etc., whether there'll be a shift in the terms of trade between our importers and exporters.
Okay. Yvette, any views on, the regulatory relaxations on digitization? You need to unmute.
Sorry, I think you are asking about the onboarding of customers, right?
Yes.
What
yes.
has been, yeah. So I think what has been already provided, I think there was also an enhancement of the limit. So we are also very happy that it is happening in a larger scale, and this is a good opportunity for to expand the onboarding and also to go into digital. And as you know, this year was declared by Central Bank as the year of digital banking. So this is good. Our payment and settlement department works on that, and they will be continuously kind of facilitating the whatever the opportunities. for us to continue this
If
effort.
you wanted to open a bank account, somebody had to physically cite your ID.
Yes.
Have you given
Now,
any relaxation on that?
yeah, because now at the moment we don't have this our ID system. The necessary facilitation is not there, but I think the register persons are also working on it. But until then, there is a slight relaxation that has been given. So that is how currently it is happening. But we will also facilitate that as as we go along.
Okay. I think we've been going on for a while. I just give a last opportunity for the panelists. Do you have any questions to ask any of the other panelists?
Can I just give one clarification? I think there's a question about the NPL position, the loans.
Right.
Now, the debt moratorium, what we spoke about the 2 months to 6 months is for the performing loans. So the non-performing loans, what you have said is to restructure or reschedule those loans, and starting from September to go in for a 3-year loan, giving some relaxation on the kind of, if it is the terms are really met, to give some relaxation on the interest payments, and also to waive the penal interest, and during this moratorium period not to take action on the certain like legal action or recovery, and to suspend those activities. So there is a distinction between performing loans and non-performing loans. We have taken note those loans are non-performing, and different treatment has been required for the non-performing loans. So though the moratorium, it will go on till 30th September, after that it's a different.
Okay. Roshan, you have anything to say? Any brief comment to make?
Yeah, I think as it's going to be a little bit of challenging year, as even 2019 was a challenging year where the NPS went up, but at the latter part of the 2019 we saw that the easing out and all in such situation. So the similar trend might have the challenges in this year, but few areas that we are a little positive is that the rural economy might turn around much little faster than what we expected, because as everyone knows, the agriculture industry is doing well, so that will fuel the rural economy. And as well as as MBFI, we are also exposed to the transportation, especially the taxis, three-wheeler, that area. So we see that some of these health regulations that has coming in, there will be the number of requirement, the usage of taxis and might go up. So some of the incomes that will coming in. So in some part of our customers we are serving, I think we might have a bit of a positive thing. Of course, when it comes to the customer, has more exposure to some other exposure to the tourism and construction, we might have to look at it separately. So, and one thing that we have seen is even the moratorium request that has been coming in, everyone is not asking for 6 months. So they're asking for less than 6 months as well. So I think that could be the reason, because the rural economy that what I explained is playing a positive role. So that may be the reason that our customers, most of the customers are requesting a lesser than 6 month moratorium.
Okay, thank you, Roshan. Manil, any final comment briefly?
Not more than what others have added. Just to mention, since my topic was financial reporting, I think the difficult times also require the right picture to be given to potential investors and depositors. Someone asked a question about depositors. I think they need to have the right information so that they also can make the right decisions. So this is not a time where we want to sort of try not to give them that right picture, is my only message that I have.
Okay, thank you. Yvette, you have any final comment to make?
I think as if all of us agree and attend as responsible citizens, businessmen, bankers, and the regulator, I think we collectively we can achieve this. Of course, it's going to be very hard. We'll have to do a lot of unusual things, make a lot of sacrifices. But collectively, we would be able to overcome this. Definitely, as mentioned by Mr. Jayesinghe, the interest of the depositors is the prime of ours, and whatever available information that we have usual the normal disclosures, those will be available, and we will also be making certain public notices from time to time, the actions that are being taken by us. Thank you.
Okay. Thank you, Yvette. Jonathan, any final comment?
We have done well so far. I hope the momentum continues whilst completely adhering to all the health guidelines without any compromise. Let's start opening the economy a little bit, from low risk to high risk, from lower concentrations to higher concentration. Let's get the mood a little change. Yes, a few numbers might increase, but if we can control the fatality, all that will change the mood a little bit, get a little more economic activity and trading going. Encourage the people, communicate, get the buy-in for people to actually start behaving under the new norm. Then looking forward to making our contribution, like Yvette said, working with the regulator, working with our customers to take them together into this new norm, which I'm all very excited about. The fact that this opportunity and COVID has actually brought this forward for all of us. Thanks for having me, man.
Thank you, Jonathan. On that note, I have exceeded, the quota that was given to me, but we had to have a lively discussion. I thank all our panelists, Yvette Fernando from the Central Bank, Manil Jayesinghe representing the Institute of Chartered Accountants, Roshan Abeygoonewardena representing the chairman of the Finance House Association, and Jonathan Alice, the CEO of HNB. From Advocata, basically, I'm just moderating the discussion, but there has been a lot of others who have helped. Basically, the Advocata team who have put together these sessions. This is the fourth over the last 1 month. And my team of analysts who have been up almost all night putting together the presentation. The presentation and video will be available on the Advocata website. And my final comment is that, Advocata advocates a certain ideology, a belief. And our strong belief is that, by getting the market system to work, it helps in solving problems than trying to excessively control. If you have market failure, you need to intervene. But it's about pushing the economy more towards the markets. And that's what we are all about. And that's why we are creating this public platform to educate the public and to create some kind of discussion. So on that note, I'm bringing this session to an end. We are actually on a public holiday. Enjoy the weekend, stay safe, and see you later. Goodbye.